Welcome to part 3 of how to read the 10K, how to interpret it. And this will be the final part of this particular lesson. And we'll be covering the balance sheet and the cash flow statement. And these tend to confuse people, but they're actually easier to interpret than you think, because there's only really a few numbers we need to be concerned with. Once again, we're not trying to be accountants here. We're not trying to dissect what every little number means, but we're trying to identify trends, and that's what matters the most as potential investors. So we'll start with the balance sheet, and the balance sheet is, you can see here in the top left corner, it says December 31st because this was the last day of the financial year for Coca-Cola. And the balance sheet is always reported on the last day of the financial year. And it's called the balance sheet because it balances. So total assets will always equal total liabilities and equity. Now, if you don't have a business background or you don't have an accounting background, that might sound confusing because you might be thinking, but they're not equal. Sometimes there are more assets than liabilities, and sometimes there's more liabilities than assets. So the way we get this balanced number is we take total assets and then we subtract total liabilities. And from that, we get equity. And equity is essentially the net worth of the business, because equity is what's left over at the end. And as shareholders, we can consider that equity as ours, essentially. So that's how you get the balanced number. As you can see here, this is in millions, so total assets. So this is 86,000 million, so that's 86 billion. 86 billion and 86 billion, and that's how it balances. So we're most concerned with things like cash and cash equivalents. Cash is king, as always. So is the company retaining cash? Is the trend going up or down? And then we're also looking for things like accounts payable, accrued expenses, accounts receivable, because this is what helps us determine cash flow, which we'll be talking about more in the cash flow statement. So I've already mentioned more cash is better. It's pretty simple. And also less debt is better. So it's very simple in that sense. We want a company with more cash and less debt. But let's talk about this a little bit deeper. So accounts receivable. In the last lesson, I talked about how on the income statement, that is companies' reported numbers. That's not cash collected. Here's where it's listed on the 10K. It's in the balance sheet. So accounts receivable is money that is owed to Coca-Cola for products that they have sold. And what we like to see with this number, not so much with mature companies, but with companies at an earlier stage of their lifespan, is we like to see this number not rising faster than the growth of the company. Because with early stage companies and younger companies, cash flow is often an issue. So we don't want accounts receivable to be growing faster than the actual sales of the business, because what that just means is the company is not actually collecting as much money as we think. And that's why it's important to look at this number particularly on the balance sheet, because we want to see that the company's growing, but not at the expense of being able to collect cash from their clients or their customers. So that's important. On the flip side, we like this number to be able to grow as well, because we want a company that collects a lot of cash but also has good supplier relationships so it can defer payments, because that just means we can have a better cash position. Because if I sell you $100 worth of books and you pay me instantly, but I don't have to pay my supplier for the next 3 months, my cash flow is much better then. And that's what we like to see with companies. We like to see them be able to collect money that's owed to them, but be able to have good relationships with their suppliers and their vendors so that they can have more generous payment periods. The other thing that we like to see is we want to see long-term debt be relatively stable or declining. We don't want to see it shooting through the roof, because cash is good and debt is bad. Doesn't matter how big the company is. Those immutable laws never change. We don't want companies with tons and tons of debt. All reasonably large companies will have debt. I shouldn't say all, actually. Most of them will, because in corporate finance, companies use debt to expand. They use debt to invest in other businesses, do buyouts. They use debt to grow their own business. So it's not as if all debt is bad, but we want to see companies that can control their debt and use their debt wisely. For example, we don't want companies that go into tons of debt just to pay a dividend, because that is hurting the long-term prospects of the company just to maintain a quarterly payment, for example. That's not a good use of debt. But we are happy to see them use debt to buy a business, because ultimately that business will be an asset for a long time. And different sectors obviously have different debt levels that we're happy with. For example, if we're looking at a REIT or any sort of real estate business, the vast majority of their expansion will be done using debt, because that's just how the real estate business works. So, we have to have different expectations for a REIT than we would for a software company, for example, because the software company has much less capital outlay needed to grow the business. So it's always good just to, remember the industry that the business is in. And that's why it's good to look at competitors as well, just to see how the business is doing in relation to its competitors. So now let's move on to the cash flow statement. And once again, you can see here, year ending December 31st. And we just look at this in terms of, okay, so how much money is the company actually collecting? And this is important because, like I said before with the income statement, income is reported, cash flow is money the company has actually collected. So we want to see net income increasing, we want to see net cash increasing, and in terms of Coca-Cola, both of those are increasing, so this is a good sign. Once again, numbers in a vacuum don't mean anything. We like to look at trends. So one ratio that is very useful to use, and one that I like using, is return on equity ratio. And that is, we have to jump between the two sheets here, it's net income divided by total equity. And let me just do this quickly. 8.9 divided by 21. So that's about 42%, which is, for a company of this size, it's a very good number. And what you can think of return on equity ratio as being is the return on investment for the money shareholders are investing in the business. So if it's 42%, you can think of it as being, for every dollar invested in the business, you get 42 cents back on top of that, which is, for a company like Coca-Cola, that's very, very strong. Often companies this size will see something around 20%, but 42 is a very good number, and that's increasing year over year. Once again, we're focused on the trend, not the number in isolation. So that's a number that's good to look at. And once again, you can think of that as the money shareholders are receiving for the money they invest in the business. So let's go back to the cash flow statement briefly and just look at some of the numbers, and just to sort of deepen this a little bit. So things like depreciation, this is all fancy accounting. Things like forex adjustments. This is what these giant companies deal with, because they have all these different risks and all these different global operations. There's also their investing activities. So companies will sometimes use their cash to invest in other things. You know, they can invest in securities, they can invest in bonds of other companies, they can invest in different vehicles that they believe will provide them a return on their cash outlay that isn't related to their core business. So, for example, here we have acquisitions of businesses, equity method investments, and non-marketable securities. So this is money they've outlaid to acquire other businesses. I believe the big one in this year was they bought Costa Coffee, which is a chain of coffee shops in about 25 or 30 countries. It's quite big over here in the UK, second only to Starbucks, I believe, in terms of number of stores. And it's quite big around Europe as well, and China, actually, and China as well. I don't believe they are in the United States, though. So that was their big investment in 2019. You see, you also have purchases of property, plant and equipment, so that's related to their core business. And then you also have disposal, so you can think of that as sales of property, plant and equipment. And this was quite high because I imagine this was the first year where Coca-Cola really started transitioning to their model of licensing the formula, as opposed to operating the plants themselves. So that's why that number was slightly higher. I wouldn't worry too much about things like issuances of debt and payments of debt. It's only an issue when the overall cash flow is really hurting. So you want to look at stuff like this: net cash with operating activities, net cash with investing activities, and then cash and cash equivalents at the end of the year. So it's slightly down from the year before, but if we take a look at the numbers, a lot of that is from the acquisition of the Costa Coffee, which I believe was about 4 billion. So they've bought a long-term asset, an existing business there, and that's why this number's slightly down from the year before. So it's always important to see things in context, and that's why when we talk about the qualitative analysis, you know, we want to look at if the company has bought any other businesses or has made any significant investments in the past year. I'm not particularly fussed about whether they pay 4 billion or 4.5 billion for a company. I'm more interested in, is this purchase aligned with the company's long-term goals? And in the case of the Costa Coffee acquisition, I know Coca-Cola for many years now has wanted to diversify out of purely being the sugary drink company because of the overall trend away from soda, which is going on worldwide now because of this health. I don't want to say health kick, that makes it sound too short term, but transition and move towards healthier options, which is why, Coca-Cola bought Vitamin Water, the sports drink company. And that's why they bought, what was the other one they bought? It's escaping me now, but one of those electrolyte drinks. Was it Powerade? I believe maybe it was Powerade. One of those. So, investing in a coffee business, once again, diversifies them, helps them absorb the slow transition away from just Coca-Cola and Diet Coke and their soda-based drinks. So that pretty much sums up the balance sheet and cash flow portion of the lesson. If you have any questions, please just send us an email, admin@freemanpublications.com. We're happy to answer anything. And yeah, if you want to see more lessons, just leave a comment down below or send us an email, because we've had some really, really good feedback about this video course, and a lot of people have been sending me messages and emailing me saying that it really helps deepen the learning of what we're talking about in the books. So we will absolutely make more of these videos, and yeah, just let me know what you want to see, and thank you for watching.